This video continues a series of videos discussing recession-proofing one's portfolio. Investing in solid assets that appreciate over time under any economic environment is key in recession-proofing a portfolio. One of the safest investments to put your money in is Dividend Kings, which are companies that pay dividends continuously and increase their dividends year after year for decades on end. In this video, I'll discuss the effects of a recession on an investor's portfolio and how by employing simple strategies, an investor can recession-proof their portfolio while continuing to gain appreciation of their assets and get paid steady growing dividend income along the way. And don't forget to smash the like button before you continue watching this video, as it will really help out this channel grow to get this information out to the masses. Get ready, you are now entering the Academy. To briefly go over what a recession is a business cycle contraction when there is a general decline in economic activity. Recessions generally occur when there is a widespread drop in spending. Recessions are cyclical in nature, triggered by one or a few various events. The last recession occurred during the 2008-2009 financial crisis, causing sharp declines in the stock market, where the S&P index dropped a whopping 37% from its highs. One thing to understand is that recessions are cyclical in nature and part of the economic cycle of expansion and contraction. An economic cycle can have periods of expansion followed by contractions over time. The peaks are moments of expansion when there is a rapid economic growth, the stock market is at all-time highs, for example, and the troughs show an economic contraction is occurring, indicative of a bear market. The phases of the economic cycle have been occurring for the last 100 plus years and will continue to occur. But one thing can be rest assured is that over time, the long-term trend is toward economic growth. This is why over time, the S&P 500, for example, has significantly grown over the last 100 years and will continue to do so. Understanding the nature of the economy and recessions can be the greatest tool for the savvy investor. Now we will summarize the steps on recession-proofing one's portfolio through a series of strategies. The first strategy is reducing volatility in one's portfolio. The measure of volatility of one's portfolio against the market can be measured by the beta of individual stocks. The definition of beta is a measure of the volatility or systematic risk of an individual stock in comparison to the unsystematic risk of the entire market. For example, the entire stock market has a beta of 1. If an individual stock has a beta of 1, then this means that the price activity is strongly correlated with the market. During a recession, if the market is down, there is a large probability that an individual stock with a beta of 1 or greater will be down as well. An individual stock with a beta of less than 1 indicates its price activity is less volatile than the market. For example, utility stocks often have low betas because they tend to move more slowly than market averages. For a savvy investor, the first strategy is therefore creating a portfolio that is less volatile than the market, with stocks that have low betas. The second strategy for the savvy investor is to diversify their portfolio across multiple industry sectors, asset classes, and regionally. A truly well-diversified portfolio contains a healthy mix of fixed income assets such as bonds and cash, as well as stocks in diversified industry sectors with companies that do business globally for regional diversification. I will not go into detail on all the steps one can take to diversify their portfolio, as this has been covered extensively in other 10x Academy videos in the channel. If you'd like to learn more on diversifying one's portfolio, please check out the video in the pop-up on the right upper corner of this video. The third strategy is to invest in dividend income stocks that have historically grown their dividends over time above inflationary rates and have consistently paid dividends over time. Most of these stocks can be found in the Dividend Kings, which are S&P 500 index constituents that have increased their dividend payouts for 50 consecutive years or more. The Dividend Kings long-term record showcases the long-term superior effect of compounding dividends, as well as the positive effect of rising dividend payout on portfolio's total return over multi-year periods. Not only that, but during recessionary periods, Dividend Kings tend to outperform other growth stocks, and dividend income continues to be paid out, sometimes with substantially increased dividend growth rates during these times of uncertainty. If dividends are reinvested during recessionary periods, Dollar cost averaging at lower stock prices generates a compounding effect, increasing dividend income substantially, spurring massive wealth acceleration for the long term. Now for our top 5 dividend kings for a recession-proof portfolio, we have the following. The first dividend king is National Fuel Gas Company, ticker symbol NFG. National Fuel Gas is a diversified energy company that operates in 5 business segments: exploration and productions, pipeline and storage, gathering, utility, and energy marketing. The company's largest segment is exploration and production. National Fuel Gas is facing a headwind due to the spread of the coronavirus, but the pandemic has affected the natural gas market much less than the oil market. In addition, the pipeline and storage and gathering segments provide a strong buffer to earnings amid low commodity prices. Based on expected earnings per share of $3.80 for the upcoming fiscal year, NFG stock trades for a price-to-earnings ratio of 11.1 compared with the fair value estimate of 15. An expanding PE multiple could boost shareholder returns by 6.2% over the next 5 years. Combined with 2% expected EPS growth and the 4.3% dividend yield, total returns are expected to reach 12.2% per year through 2026. The second dividend king is Federal Realty Investment Trust, ticker symbol FRT. Federal Realty is a real estate investment trust or REIT. It concentrates in high-income, densely populated coastal markets in the U.S., allowing it to charge more per square foot than its competition. Federal Realty trades with a market capitalization of $6.7 billion. Federal Realty's business model is to own real estate properties that it rents to various tenants in the retail industry. This is a difficult time for retailers as competition is heating up from e-commerce players such as Amazon and many others. Mall traffic is declining, which has put pressure on many brick-and-mortar retailers. Conditions for retail real estate have become even more challenging due to the coronavirus, which has forced many stores to close. Federal Realty's competitive advantages include its superior development pipeline, its focus on high-income, high-density areas, and its decades of experience in running a world-class REIT. These qualities allow it to perform admirably and continue growing even in a recession. The forecast for this REIT is 5.9% annualized FFO growth for the next 5 years. The third dividend king is Lowe's Companies, ticker symbol LOW. Lowe's Company is the second largest home improvement retailer in the U.S. after Home Depot. Lowe's operates nearly 2,000 home improvement and hardware stores in the U.S. and Canada. Lowe's reported third quarter results on November 18th and recorded net earnings of $692 million compared to net earnings of $1 billion in the prior year. Excluding a negative $1.05 impact from extinguishing debt, adjusted earnings per share increased 40% to $1.98 from $1.41 in the third quarter of 2019. Comparable sales increased 30% for the quarter. The key to Lowe's success over the course of 2020 has been its booming e-commerce platform. In the most recent quarter, Lowe's registered triple-digit online sales growth. This is a key differentiator between successful retailers like Lowe's and the many retailers that are reporting losses or going out of business. Lowe's is benefiting right alongside the e-commerce boom. Lowe's enjoys competitive advantage from scale and brand power as it operates in a duopoly with Home Depot. Neither of the two are expanding their store count significantly, and neither is interested in a price war. Both should remain highly profitable as the home improvement market in the U.S. is large enough for two companies to succeed. Based on expected EPS of $8.60 for the current fiscal year, Lowe's stock trades for a PE ratio of 18.7. The fair value estimate is a PE of 20. The combination of an expanding valuation, EPS growth, and dividends lead to total expected returns of nearly 10% per year over the next 5 years. The fourth dividend king is Black Hills Corporation, ticker symbol BKH, an electric utility company that provides electricity and natural gas to customers in Colorado, Iowa, Kansas, Montana, Nebraska, South Dakota, and Wyoming. Black Hills Corporation reported its fourth quarter earnings results last February. The company generated revenues of $490 million during the quarter, up 2% year over year. Earnings per share of $1.23 for the fourth quarter increased 8.9% year over year, showcasing the resiliency of the company's results during the pandemic. Strong results were mostly due to higher natural gas demand for heating, which was again showcased by the above-average profitability during the fourth quarter. The company is forecasting earnings per share of $3.80 to $4 for the current fiscal year. And not only that, but the dividend payout appears to be safe as the company pays out roughly 60% of its net profits in the form of dividends. With a dividend yield of 3.8% and an expected annual EPS growth of over 4%, Black Hills Corporation is a solid investment for the long term, even during recessionary periods. The final dividend king for a recession-proof portfolio is Altria Group, ticker symbol MO. Altria Group was founded by Philip Morris in 1847. Today, it is a consumer staples giant. It sells a Marlboro cigarette brand in the US and a number of other non-smokable brands including Skoal, Copenhagen, and the St. Michel brand of wine. Altria has a 10% ownership stake in global beer giant Anheuser-Busch. On October 30th, Altria reported financial results for the 2020 third quarter. Revenue of $5.7 billion increased 5% year over year and beat analyst estimates by $140 million. Smokable volumes declined 0.2% for the third quarter, much better than the 4% predicted drop. On a GAAP basis, Altria reported a loss of 51 cents per share as the company took a non-cash pre-tax impairment charge of $2.6 billion related to its investment in Juul. It operates in a highly regulated industry, which virtually eliminates the threat of new competition in the tobacco industry. Altria enjoys strong brands in its product portfolio, including the #1 cigarette brand. As a result, it has pricing power and brand loyalty. In addition, tobacco companies enjoy low manufacturing and distribution costs thanks to economies of scale. In the meantime, Altria has a very high dividend yield of 8.6%. The payout appears secure as Altria generates huge cash flow even during recessions. The company has increased its dividend for 51 consecutive years. Altria ranks very highly in terms of safety because the company has tremendous competitive advantage. In addition to the 8.4% dividend yield, as well as a small positive boost from an expanding PE multiple, total returns are expected at 14.4% per year over the next 5 years. I've just mentioned 5 solid companies that even during recession keep producing and generating sales and paying dividends. They may not be the most glamorous, but they are defensive by nature even during recessionary periods. These dividend kings are a great investment that not only pay dividends, but fortify and recession-proof a savvy investor's portfolio. Investing in a well-diversified stock portfolio with stable dividend income producing assets can be the smartest and safest investment for those looking to create wealth over time. By employing the recession-proof strategies mentioned in this video, along with safe and smart investing techniques discussed in other 10X Academy videos, such as value investing, dollar cost averaging, and dividend reinvestment and diversification, one can create a low-risk dividend income flow that will grow over time and continue to pay income. Check out the links in the description on how to start investing in dividend income producing assets that you can use to safeguard against recessionary periods while starting your path toward financial independence and freedom. Thank you for watching the 10X Academy channel. Please make sure to smash the like button if you enjoyed watching the video. It will really help out the channel and the YouTube algorithm for bringing more wealth creation strategy videos to the masses. And if you haven't done so already, be sure to subscribe to the 10X Academy. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.